Good evening, ladies and gentlemen. My name is Viral Shah, and on behalf of IFA Wealth, in partnership with MCX, a warm welcome to this masterclass session on asset classes. Over the last few weeks, we have been able to curate a specific agenda, a specific seminar series, which we have been able to get leading global experts, consultants, and fund managers to discuss about various asset classes. Today's session on asset class across a very interesting asset class, which is base metals, and we will be focusing on the changing face of metals trading and investments in India. It is my privilege to welcome our esteemed panel. We will start with Mr. Anurag. Anurag Sharma is currently the Joint President for the Primary Aluminum Division at Hindalco Industries. He has more than 23 years of experience in various capacities at the Aditya Birla Group. Currently, he is responsible for the global sales, business development, and brand building for Hindalco Industries in the aluminum division. Our next panelist is Mr. Anuj Bareja. Anuj currently is the founder for Asier Metals, a metals trading firm focused in the Middle East and Southeast Asia markets, apart from India. Anuj earlier used to be the head for primary and scrap metals trading at Trafigura Industries. He also brings in more than 15 years of experience, having worked in Hindalco prior to joining Trafigura in 2011. The third panelist is Mr. Bernd Shishka. Mr. Bernd is the global head for metals and iron ore at Refinitiv. Bernd brings phenomenal amount of experience both on the physical side as well as the futures trading segment at various organizations prior to joining Refinitiv. In a stint at Credit Suisse, he was also a portfolio manager as well as a proprietary trader for various base metals and precious metals as well. And at the end, I would like to invite my Mr. Chitrajan Rege. Mr. Rege again brings in more than 20 years of experience in the financial markets as well as in commodity price risk management. Mr. Rege is responsible for steering the base metals contracts of MCX from a both delivery contract or a cash settled contract into a physical delivery contract. And he has been with MCX for more than 7 years now. And it is my pleasure to invite him to deliver the keynote address. Over to you, Mr. Rege.
Thanks, Viral. Good evening, everyone. I'm really happy to be, part of this seminar. Now webinar as a medium has become a new normal to all of us now. So, we with this initiative to reach out to the maximum and different participants in the times when face-to-face meetings and otherwise is so difficult. So when this proposal came up and jointly with Viral, we decided that we should go about it. As regards MCX and what we do, I'm sure most of us are aware, but something which is very interesting story for last 1.5 years I wanted to share that financial year 1920 was a great learning year for all of us at MCX, especially the metals team. Until that time, all our contracts were cash settled. What we use in the Indian market, the terminology was both option contract, which essentially resulted into a cash settlement of the contract. So last financial year, we sequentially converted our contracts to be delivery based. So starting from aluminum in March 2019, zinc in April, I think nickel and lead went live delivery base in June, and finally copper in July. So it has been very interesting journey. Lots to learn, but we believe that we brought a lot of value to the table for all the participants in the market, and slowly the acceptability of what we have done is increasing. While we did that, I must acknowledge that there is very strong product advisory committees for all the metals we have, and there are constant guidance from them, which constantly tells us as to what's relevant, what changes we need to do, and we have been incorporating those over the period of time. I'm happy to state that in this last 1 year, so I mean from March 2019 and onwards, nearly 74,000 tons of metal has changed hands via the settlement cycles of the variety of metals. So Cumulative, I would say aluminum and zinc would have been about 24,000 tons each. Lead will be in, somewhere close to about 5,000 tons. Copper will be in excess of 18,000 tons, and nickel also, would be about 1,000 tons odd. Cumulative from, ever since we got them converted to delivery base to till now. So at the moment, we accept only LME registered brands to our delivery, and as rightly mentioned by Viral, we are in process to look at how we can increase our reach, our bandwidth, so that it becomes more holistic for the domestic price discovery. So the agenda is very, very broad for us. We are going to engage with more and more players so that this reaching out happens. So what else is on agenda? We want to reach out to multiple regions for the warehousing so that access, the settlement and all of that becomes relevant to much broader participants across India. And secondly, much more important is we are increasingly looking at very closely as to how we can bring in the additional brands, additional producers who can, without compromising the chemical specs of the commodity, can bring additional supplies to this, so that the price discovery becomes far more holistic, becomes a good reference for broader market, and acceptability of it goes further. So, while I say so, I must tell you that, when I say that the year was of great learning, it includes the time, recent times of this pandemic where, other than price discovery mechanism, we also are positioned well to be the delivery destination of the metal of the last resort. And particularly for the times of last 2 months, I believe, steadily we have been seeing inflow of goods. My reading about this, limited knowledge of that is that, while the offtake in the consumption sector being so limited, a lot of people would have seen value to deliver into the MCX warehouses. I'm sure, there. I mean, in the once the panel discussion starts, we will have more insights on all of that and what else can be done. So, friends, I'm very happy, that we are in the company of the elites today, who will give their valuable insights to, to tell us as to where the markets are and how it is unfolding from here on. In terms of, this thing, I just want to thank each one of you, from MCX Investor Protection Fund. So Anurag from Hinda, from ACR for, kindly been agreeing to be part of this, to share their valuable insights. And also to Viral and IIFL Wealth team for putting together this fantastic show. While I am on standby, Viral, over to you.
Thanks, Chitranjan. Before we start the panel discussion, just wanted to highlight the flow. So probably after about 30 minutes, we will have a small Q&A session. So if you have any questions that you want to address to the panel, you can start putting it up, and I'll collate it and I'll ask the panel post about 30 minutes or so. So thanks everyone, and we will start off the panel discussion. So Anurag, you bring in a very interesting perspective, so far metals trading in India was always with reference to the LME pricing, whether it was at a premium or discount to the LME rates. And now with the delivery-based contract starting on MCX, you have a settlement price that gets displayed, at which physical deliveries do take place, albeit compared to the size of the global markets, it is still very, very small. But what has been your assessment of these new contracts, this delivery-based contracts? As a primary producer, how do you see the value of these contracts for your business, or how do you see the growth that is likely to happen over the next couple of months?
Yeah, thank you, Viral. Viral, if you look at from a producer perspective, I will say that a new MCX is going to be a very good for Indian producer in times to come. In a near-term basis, and that there is a great disparity between MCX and the other exchanges, which are normally referred to by the producers, sellers, and consumers. But that disparity is always happen. That arbitrage, negative or positive, always happens whenever there are two exchanges, right? So, but given the fact that a new exchange has come in India, so in an initial period, I find that there are some teething troubles. There's a very high level of disparity between the existing exchange and the MCX. But I feel that as we go along on this, as we move along on this, and as the volume increases, as the liquidity increases, this is going to be a game changer in times to come in Indian scenario. And as a producer, I foresee that this MCX will in times to come will help producers to actually find a good marketplace to sell their material to their customers.
So continuing with this point, as Chitranjan was mentioning, and IFA Wealth also has been able to kind of partner with a lot of participants who have given and taken delivery on the exchange platform. What I hear from you is the fact that that currently the size of the market is too small, and because the size of the market is small, it creates this disparity. So what we require really is the market to grow in shape and size, because considering the size of production of aluminum in the country and what gets traded is it's a very small percentage, it's a very minuscule percentage of that. So, how does the exchange kind of reach to that level where you will see more active participation?
Okay, see, I think that this is going to be a gradual phenomenon because the customers in India are used to work in a particular fashion. So breaking that fashion will take its own time. So MCX do provide a lot of opportunities when it comes for a hedging of their risk. So when a customer will know that there is a mechanism available to hedge their risk, then I feel that more and more people will come to the MCX and will hedge their risk. And as the real buyer and seller will start hedging their risk on MCX, then you will find that acceptability will increase. Even the way the aluminium is being traded as of now will change in times to come. So that is something which I foresee it will happen in the near future. As of now, really it's basically I'll call it that it is a teething troubles. So MCX is going on a teething troubles and these were bound to happen. We know it. But gradually, I would also request Chintrajan over here that MCX need to approach all the customers to basically teach them, tell them what are the advantages MCX can bring to the customers. And if customer will really find, and I'm sure that customer will find because everybody wants to minimize their risk. The moment customer will find a tool in his hand to minimize its risk, you will find more acceptance. More acceptance will bring in more liquidity, more turnover, and after some time, then you will find that MCX will be a new benchmark in the country.
Thanks, Anurag. So, I want to now bring in a perspective of a trader into this discussion. So, Anuj, you have been one of the early adopters of the MCX delivery process. I think you have delivered various materials inside the exchange, and I've also taken delivery of commodities like zinc, lead, and copper as well. What has been your experience, as a trading outfit, as a trader for refined and base metals, what has been your experience of the exchange? How has that impacted your business?
I think, guys, first of all, thank you for having me on board. My views are a little bit different as compared to producers because we come from a trader mindset where we can do both the things. We can buy and sell at the same time, and arbitrages are very good for us. We totally agree that in these times, arbitrages are sometimes positive, sometimes negative, and they do hurt the market because the market wants to buy what they see on the screens. And a recent example is oil, where you talk to anybody and everybody was making a beeline towards oil. So things like this, I would say MCX has brought up a new change in the society, in the manufacturing one, that's one. People will make a beeline as it gets matures more and more, the arbitrage will shrink. But yes, it will give a definite advantage to all the producers to buy the metal from MCX because they can hedge and they can take delivery as and when they want. Now, keeping in view our experience, I think it was seamless. There were few teething issues which we resolved, But other than that, delivery of a metal is seamless. You can deliver the metal in the same day, and you can also take the metal within 2 days' time once everything is set and the systems work seamlessly. You just need to understand the process, and once you are done, I think there is no issues for delivering and lifting the metal from our side. And in times to come, we definitely see that this size will keep on growing and growing as the market becomes more and more mature. So we are very positive to look at that, and we are very gung-ho that yes, MCS has taken a leap, though we waited for it for 10 years, but in the end it happened. So I would say like that. Thanks, Chitranjan, for doing that. We pushed it, and thanks for doing this, for bringing it to India finally.
So thanks for your starting comments, Anuj. So to our viewers, what we also wanted to highlight is that not just the delivery part on the exchange. What has happened is MCX has created this entire ecosystem where commodities are dematted and they sit inside what we call the commerce account, which is nothing but a demat for commodities itself. And not just at the time of the settlement cycle, which comes towards the end of the month, and it's actually spread over 5 days, so it's a deferred settlement cycle per se. But we are now even seeing where traders or consumers and traders or certain other participants and traders are able to exchange physical material even during the preceding 25 days of the contract. So at any point in time, there is now developed an ecosystem very similar to the warrants on the LME, where if you have material inside the exchange and you have the credits for that inside Commerce, that people are able to exchange those credits or that inventory of metal that they have on an off-market basis, an off-market transfer system. And this is one of the ways in which we are seeing the physical market and the futures market getting more and more in sync. Because somewhere I think the benchmark is now getting towards the futures price on the exchange. So the physical market would trade at a small premium or discount compared to the MCX price. So any thoughts, possibly Anuj and Anurag, you guys can bring on to the table?
I think Anurag can lead this talk because they are from the producer side, they would know it better. Then I can add to that.
Okay, rather I felt Anuj will be in a better position.
No, I always follow a producer in my line. So because we are traders, we always follow the producers who give us the metal. So there you go, buddy.
Okay. I do agree with your presumption that that MCX is going to be a game changer. And but there is only one hiccup which I feel, and the hiccup is basically that as on today, if you look at, like Anuj said, that he has sold metal on MCX and he has bought on MCX also. But there are very few real metal players, correct? As on today, if there are buyers and sellers, if they really participate in MCX, for that MCX have to do a lot of homework, lot of groundwork. But the moment they come into this, then you will find that disparity with the other exchanges will get minimized. You will find that the real value which MCX can deliver will be actually delivered to the customer. Customer will be able to make use of it. So the moment that happens, it is actually going to be a real, you can say, value enhancer for the organization, for the companies. And if you look at Indian scenario where most of the people who don't have access to the exchanges are small customers, right? Now these small customers, if they have an approach and access to MCX, you can imagine the kind of value you will be adding, bringing to their organization. So I feel that times to come, yes, MCX will be a game changer. They really need to bring in, do more hard work to actually open up or bring in that value. From a marketing perspective, if you look at from producer side, if I say, producer side, I really, as a seller, since I'm a seller, so I'm looking for a positive arbitrage wherein I derive better realizations when I sell on MCX. Probably this is, you can say that this is one-sided affair for a producer. But I feel that going forward, because we had only transacted once on MCX, and we are quite comfortable with the process, with the systems, with the checks, with the controls, with the mechanisms, with even the staff. So that kind of, I think it's a professionally managed. So I feel in going forward, M6 will be a real game changer for producers also. And producers will be forced to relook at the ways they have been selling in the market. Because at some point of time, MCX is a competitor. At other point of time, MCX is a customer. Anuj, would you like
Very
to add?
interesting.
Look, I would like to add a very few points. I'll give you an analogy over here. When Amazon came in India 7 years back, we were shying away from that. Today, I think everybody buys on that. It's just a matter of time. And with the speed of the time with what we are going and post this pandemic, I think it's very evident that people will believe in what they see and buy. And M6 gives us transparency in the market. Today, if a buyer sitting in, let's say, in a remote location of Himachal wants to buy and price 5 tons, it's very difficult for that person to go to the producer and to hedge that 5 tons and ensure that when he can get. But at the same time, he can hedge the price and take the benefit of that. And in due course, he can lift as and when the material is available. So for me, the key for the next, I would say, paradigm shift with M6 would be going deeper into the zones where the consumption centers are. Today, you are based in West and South, and you have to go towards more than the other location, I would say East and North, or maybe the Central. And moment you have it, you can cover the entire pan India. So I think that's one. Second, look at the geography of India. To move a ton from east to west, it takes 3 to technically 4 days time. And MCX warehouses, if you have got all over, can be reached or can be, I would say, one can buy within 24 hours. So that gives just-in-time delivery. That helps the customer to hedge. And the best part is show the transparency which is there. Now, arbitrages and all, they can be fine-tuned because as and when more and more players come on it, the arbitrages will vanish, no doubt about it. But that will take its due course of time. But till then, I think that's the best thing for any small producer who can come and who want to take care of his risk, can mitigate that. So imagine in COVID, in the last 2 months, what people are doing. People who are sitting on inventory, they don't have cash. At least with the MCX, they can at least deliver over there and can pay their staff. So that has come very handy to them. So look at from both the sides of the view. The coin has always got two sides. And I would say sometimes it works in a favor of producer, sometimes it works in a favor of buyer. So you have to go with the stride. And I think M6 is a game changer in this country. And I will be very keen to do more and more. And I see the volumes will increase rapidly in this model in this year, in this financial year, for sure.
Thanks for a very insightful analysis on how MCX is catering both to the producers and traders. So what we'll do now is quickly kind of look at the questions that have been posted, and before we go on to a little bit more analysis on the macro trends in metals, and also discuss in terms of how new investment avenues will come for participants on the metal side. So a question, actually, I think most of the questions are more centered towards MCX and towards Mr. Chittaranjan Rege. Is the plans for MCX on accepting brands for delivery apart from the LME registered brands, and also about having additional delivery centers or creating a network of delivery centers on a pan-India basis? So, we'll quickly take these two questions clubbed into one, and after that, we'll head over to Mr. Byrne for his analysis on the markets.
Sure. So incidentally, both the questions are very much in sync with what probably Anuj highlighted and Anurag insisted. As you would appreciate, Viral, the way in which the exchanges are functioning is it's a batch processing in terms of what all we would like to bring in, and whenever we bring in anything new, it requires a decent amount of time for the entire set of market participants to understand and adopt to the change, and only then we can introduce another change to the market. Making it pan-India delivery base without a doubt is on our agenda. If you remember when we all started, lead used to be only Chennai as primary delivery center and nothing else. And so are the other metals also. The rest four are, Thane is the only delivery center at the moment. But moment we realize that on that additional delivery center is required to be added, and we added Thane to the lead as an additional delivery center at par. the response has been fantastic. So this is a batch process. So this was in I think last September or October when the additional delivery center in lead was added. So I'm sure that once the another set of change which we are introducing from June, when the contract size or contract lot of zinc, lead and aluminum goes up to 5 tons. Once we are through with that cycle as well, I am sure the incremental set of change on additional delivery centers and brands is on agenda. It will be brought in for sure. Coming to the other issue of whether domestic brands, yes, very much on agenda. We do not, I mean, the highlight or the input or the guidance given by the product committees to us is we do not want to compromise on the chemistry part of it. As long as the chemistry part and the physical properties are met with, we have to devise a mechanism where the domestic producers can also come in. We definitely see a great value of this in the refined lead market for sure. That's going to be the next on agenda for us. Legwork is already on. All I am saying is while it is on agenda, it is going to be batch processing, and we are certainly going to cater to the market requirement in this financial year for sure.
Sir, Viral got disconnected, so he is joining back.
Sure. So I mean, from what Viral had mentioned, so he also wanted to hear the views from Bernd on what his assessment of the Indian markets from outside, and what's his insights on how this is going to unfold in times to come. Over to you, Bernd.
Sure, thank you. Yeah, thank you, and thank you for having me on this exciting webinar today. So, yeah, I think I'm based in London, and I've spent most of my career mostly active on COMEX and LME futures contracts. But I think what I hope my presentation is visible now. So just did a brief exercise. I went back 5 years and just wanted to see how are LME, COMEX and MCX related to each other. So just taking a 1 month rolling contract, and it's quite interesting if you look on the right hand side, the correlation that pretty much it varies between 0.9 to 1 perfectly in sync over that entire period. So it's quite interesting, obviously, with financialization globally and people as was mentioned earlier, trading arbitrage and looking for opportunities between exchanges. So clearly MCX is now has sort of the same way of bearing on sort of the price discovery than as the LME and COMEX exchanges. And as we will see a bit later, I want to briefly touch upon one very interesting sort of group of or segment of the market, which are the algo or quant traders, which I think probably have helped to make markets more correlated to each other than not. But before we do that, I'm going to focus on copper here because that's something we would do a lot of research into. And I think given the extraordinary times we're in, I thought, let's have a really long-term look back on actually what copper does on a macro basis. So we're going back to the 1950s here on the LME cash copper price. That's sort of the longest time series that we have. And if you overlay, the US recession bands here in gray, you can see that the sort of negative variations that we've seen over that period can vary from going down to -60 in the great financial crash to currently down around 10% on a year-on-year basis. So obviously prices have strengthened over the last since the bottom sort of in March, and I think the narrative now in a lot of people's mind is yes, the reopening is happening and everything goes back to normal. So commodity prices should go higher, which nobody has a crystal ball, but for me it's just interesting that when we have those gray bars here, that the downward movement in copper in this case can be more exacerbated than people would expect. So I think nobody expected copper to go down 60% year on year in a great financial crash. So I'll leave that with you for your own thought process, but it's just important that those tail events, which the market seems to be always mispricing, and then they happen and people are very surprised about them. Digging a bit deeper, we look a lot. I like to analyze a lot the business cycle. So I'm using the US ISM Purchasing Manager Index against LME. Again, you could look at the MCX contract or COMEX or any other exchange contract. They're pretty much are still driven by the US business cycle. Why we think that is because the US dollar is the reserve currency, and the interest rate policy of the US has a massive impact on all the economies globally. And again, in orange, the ISM index, if it's above 50, means the economy is in expansion. Below 50, it's in contraction. And copper year-on-year basis, again, we're seeing now a massive decoupling with ISM at 41.5, so clearly recession, if not depression territory, and copper is only down 9%, and as I said, has actually been on a year-on-year basis improving versus a negative trend on the, on the business cycle. So that's something definitely to watch, and I wouldn't be surprised that at some point that we could see a move lower in the overall metals and base metals complex. In addition to that, global trade is now, and these are, I think, only February numbers. We get them from CPB, which is an institute in the Netherlands. So we're down almost 2%, again, year on year. So with the trade slowing as well, we'll have to see how strong really the demand side of the base metal space will be going forward. And then obviously China is always an easy one. The narrative, yes, China will just stimulate and everything will get back to normal. So we're looking at China social financing here. 1 year moving averages just to filter out Chinese New Year against the copper price again. And, you had those three massive peaks, 2010, 2013, 2018. But, the peaks have never really exceeded what we've seen in 2010, and only barely in 2018 we exceeded the 2013 one. So copper is crashing here on this chart further, whilst the Chinese seem to be stimulating more. So that mechanism as well is not really, the additional stimulus from China is not really feeding through into the prices of copper in this case, and we'll have to see if they just stimulate a lot more, which I think is currently what everybody's expecting. But we'll just have to keep close eye on this narrative that China will bail out again the rest of the world and stimulate the demand side of things. And I just want to spend 2 to 3 minutes on those CTAs, computer traders, which I've spent almost a decade researching and also trading some of these models. And I think if we take a step back, and I call this slide human against machine, 2008, that's the UBS trading floor in Stamford, Connecticut, that employed about 4,000 traders. 2016, unfortunately, guys, it's time to pack up your computers and everything else. We're shipping out and we're closing this operation. And now you have the luxury of just putting your hard drive with an algorithms in any of the futures exchanges, let's say on LME or even on COMEX and others. You just put in your hard drive and you run an algorithm. So, there are a number of companies, I've just put a couple up here, like the 2 Sigmas, Jump Trading, XTX, DRW, HFTs, high frequency traders, who pretty much trade 24/5, normally very small lots, just to get in and out and then make the bid-ask spread. And you might ask yourself, well, okay, so you're telling us about these algo traders, how important are they? And the only data that I could really find was from the CME, who are doing actually a pretty good job here. And if we look at copper, gold, and silver here, or if you want to just focus on copper, might be easier. So 70.2% of all trades between NOV 16 and OCT 18 were generated by algos, i.e. no human being clicked the button and said, hey, I want to buy 3 copper here or sell 2 copper there. So 70.2%. And then it's interesting who is trading with who. So actually, human being against human being is only 10% now. And 52% were done algorithmically, algos against algos, and then you have 36 algos against the human, which is probably the algo just picking off the human trader on him needing liquidity either on the bid or the ask side. And that 10% was remarkably down from 20% 2 years earlier. So it's really interesting that you'll have massive distortions potentially, and a lot of our clients are telling us this, that you read a news story or you try to find some narrative in the market on a given day, and the news story is saying copper should actually go higher, but you actually have a completely opposite movement. That could be a news story, but it could be also like a Chinese import and export data that comes out, or any GDP figure. So this is really important for anybody looking to invest, or even if I want to hedge, you have to be aware that there are price distortions in these markets due to these algorithms. And one thing I've done at Refinitiv now, which I'll show you later in a sec, is we have a newsletter that actually gives some guidance on when these people will be active. And in total, I mean, you have $320 billion now invested as of Q4 in those, what they call CTAs or trend followers. So that's a huge number. That's obviously gone up. So as more money goes into these funds, they all tend to be trend following in nature, buying upward trends and selling downward trends in its most basic form. basically that's why more and more money goes in. That means the volume on these exchanges that are traded by these people, as we've seen, have gone up substantially. So one thing I'm doing on sort of a weekly, bi-weekly basis, I have here, I've done this for LME and COMEX, and I'm in the process of seeing if I can get something for MCX contracts as well. But basically, rather than being reactive after a big price move has happened, I basically create some buy and sell signals where on some back testing and trading analysis that I'm doing, I give you some indication where potentially some of the models that I simulate will trigger. And I simulate about 40 models. And what I'm saying here is last 2 days, we've seen some buying. So, if copper is at 5,428.5, we would expect at 5,455 around there that 17.5 of the models would buy. And likewise on the downside, aluminium is actually, at 1455, you would almost see 87% of the models sell. So you could expect some further downside, if we get to these prices. So it's a purely mathematically driven model, which removes any human biases and any, fear or greed that one might experience, because computers don't read news. They have no emotions. They will just trade what the signal says. And that's what I think is confusing a lot of the traditional hedgers, producers, arbitrage traders who are not aware how dominant these people have become. And with that, I'll just leave here. If you want to subscribe to something like this, it's a very short email, so there's no spam. You will get that from us if you go to that website. So happy to take any questions. And, thanks again for giving the opportunity to present on this panel.
Thanks, Bern. That was a very insightful presentation. I'm sure that our clients would love to get a copy of this presentation as well, but it's interesting when you brought it out with regards to how CTAs are now dominating the metals trading part as well. And in India recently, our regulator has allowed for mutual funds, portfolio management services, and alternative investment funds to kind of invest in commodities markets. Again, we are still trying to finalize as to what shape and size would some of these funds look at. But with your global experience that you have seen, how much do you think is the total asset under management in the base metals commodities pack when you compare it with, let's say, a precious metals or energy products, which are obviously much more deeper?
Yeah, I mean, definitely. You certainly with the CTA numbers that I've shown you, that's that 300 billion. That is, they only have some of the metals in their portfolio. So I would think that maybe of that, maybe it's less than 1% would be, maybe 2% would be purely invested in base of precious metals, because these funds run up to 300-400 markets. So I can trade Brazilian soybeans, I can trade, MCX, if it's possible, I can trade FX indices. Purely, I think I think the number of pure index funds has definitely dropped. I mean, I would be surprised if we have more than $1 billion now maybe invested there. What we've seen is a lot of the index trackers of commodities have actually seen some outflows. So the Fidelities and others who run a pure long only commodity fund. I mean, you can imagine how that recent oil drop to negative would have impacted, as well. If you have a broad commodity index fund, it's just the roll yield is terrible. So that as well, I think, doesn't help that most of the time you see a contango structure in metals. So something like aluminium over the last decade, you would have lost quite a lot of money just from the roll yield. So that's why I think that the overall size is probably, I would say maybe a billion plus. We can definitely share some more numbers, in the presentation. I can send that around. But yeah, I think it's definitely limited. And maybe back to you. I mean, how is the situation, I guess, in India in terms of sort of pure commodity investment funds? Is this something as well that exists which are referencing the MCX price? Are investors able to get exposure that way?
So in the current scheme of things, because all these regulations have just come in the last 6 months, one of the stumbling blocks of this was that in India we require to have a custodian to aggregate all the physical deliveries as well, and you need to have a custodian for clearing all the trades on the commodity side. So the approvals for custodians to be able to offer even base metals has just come in recently, which is why most of the large fund houses and all are back on the drawing board in terms of how to create new products, whether it could be a long short fund in commodities or it could be something for a cash and carry arbitrage where you're buying the physical and then you're rolling over the futures contract. What is going to be interesting is when I look at the global markets, and there are so many funds which are between a London Metal Exchange and a Shanghai futures market, and between a London Metal Exchange and the COMEX as well. So it's almost an exchange arbitrage that exists. In the current form, what we feel is because MCX has become a delivery center, and in the last 12 months, we too have cleared many deliveries for clients which are importing from various countries, including Russia and some of the other producing countries like Japan. That there is a possibility for an exchange arbitrage, which traders will be able to benefit. But when it comes to fund houses and institutions, I think because the play is more in terms of only MCX, they will again, like I said, have to go back to the drawing board to see as to how they will come out with strategies, whether it will be on the long short side in commodities, because they can't do the exchange arbitrage. So they will have to innovate a bit in terms of what products to offer to the clients for getting an investments. But one of the interesting things which probably Chitranjan can address over here is that MCX has now come out with an index which is likely to be available for trading probably in the next 1 quarter, where there is a specific base metal index and there is a specific bullion index. And we will likely be able to then create an ETF which would track the index itself. So probably Chitranjan can throw some light on that.
Yes, Viral. So, I mean, just to touch base on what Bernd was mentioning, Bernd, even here. So, I mean, this is a good start. What Viral has just mentioned as to what all has been allowed now. And compared to, we have a benchmark as to how the equity markets operate in India. So, landscape wise, we are very clear that there is lots to achieve. And I'm sure, as we make progress, there is more regulatory, I would say allowance, and, this thing will happen. And I'm sure this is going to unfold in a much more possibilities will be opened up. Now, having said so, the where we think there are challenges in terms of which even Anurag mentioned, which Anuj also mentioned, was in terms of how the existing players, whether they're physical players or this thing, they understand their conventional physical metal pricing, and ever since in last 1 year how the MCX has come into play, what practically their assessment is that it's a disparity in how they understand the markets and how the MCX operates. That's one. But I believe it's only they are conceptually attuned to some different method of pricing, and ours is a different style of pricing. But I'm sure this reconciliation will happen. So talking about the index, now indexes are completely glued in or designed, modeled around our own contract. Based on the volumes on individual metals, so 5 metals: aluminum, copper, zinc, lead, and nickel. The combination has been created. Things are with the regulator for for the approval purpose. So probably it will be tough for me to give more details on the product this thing, but it's a combination of these 5 metals. So we also take into account what is the volumes traded on the exchange and also the physical market size. This combination will define how the ratio will get done eventually. But that's definitely going to be one of the offerings in sometime very soon.
So that's great to hear, Chitranjan. I think it will change the way in which even investors are looking to kind of look at alternative assets, including bullion, including metals, to kind of allocate some parts of their portfolio, especially in the current scenario where there is so much of uncertainty in the global market. So people want to have an exposure to commodities. The only thing is in India, because we have not been able to design these products, more or less all the investments filter out only in bullion per se. At this point in time, again, would kind of throw a question to to the panel is, when you have a scenario where it's no longer just a producer and consumer in this market, globally, obviously you have banks, you have producers, consumers, CTAs, hedge funds, and everything else. In India, so far, the participants on MCX were either speculators or they were arbitrageurs who are able to kind of participate on cash settled contracts. But with this new set of institutional participants coming in with obviously more access to information, like a mutual fund or an alternative investment fund. How do you see the market develop? And this possibly, both Anurag and Anuj can address too. How do you see, these new players in the market who are not your traditional buyers and sellers of commodities? Now suddenly you have a scenario where a portfolio management service can actually hold physical commodity and can sell futures and make a cash and carry arbitrage return in the market. How does that impact the overall physical trading as well?
Right, Viral. My view is that when we talk about an MCX actually MCX is something which is developing an ecosystem around it, right? And all these speculators, hedgers, arbitrageurs, portfolio managers, producers, sellers, right? And even you will find there will be some people who are short-term players, some people who are long-term players, who will have some different views on them. So these all people actually constitute an ecosystem, right? So when you look at from a producer perspective, so we have been living in this ecosystem, which is basically revolving around LME as of now. But going forward, if you look at it now, I have an option. There is an LME, there is an MCX. But if you ask me, in times to come, like China has got its own MCX, Shanghai Futures Exchange. So probably I foresee that MCX will also grow in times to come. That Hindalco will be really a part of, it will be an active part of this ecosystem, and will be. And you always need a support. Anuj will always bet. You always need a support and active participation of the producer, because the material has to come and it has to move. The moment it is making the turnovers, you will find that the value which MCX is planning to bring will really come onto the ground. That's my view, and I feel that I don't see any harm in having all these people, because somewhere they will bring in some value to the entire system, and that's why. And one more way to look at it is that these are the people who actually bring a pure market play into the market. Suppose if they are not there, then it is purely on a demand and supply of material. Now it is demand and supply of funds, it is demand and supply of aluminium, it is demand and supply of aluminium vis-a-vis the other commodities. It will bring in the political risk, it will bring in the geographical risk, it will bring in all sort of risk. So the price discovery mechanism actually automatically brings in, or I would say it automatically consider all these aspects, and the price which is discovered on MCX is a true reflection of the price of that commodity.
Great. Anuj, your views on that?
I think it's in a very different way. I come from a background where I would like to answer this question in two ways. One, where do people going to invest nowadays? People are having the negative signs about China and other stories. They're looking at India as a bright spot. India is maturing. We are changing gears, and we are inviting a lot of people. So I see a lot of hedge funds, a lot of new, I would say, kind of structured deals coming to India. And MCX and metal are the story where the new funds are going to be played, because bullion is more or less matured. We have seen gold and silver maturing over a period of time. Now, shall you want to put an aluminium fund? Why not? The country needs it. Let's say if you go from the government point of the view, who is planning to spend huge on infrastructure and projects, country needs aluminium. And if you read the NALCO's chairman's view, he says by 2030 we need 10 million ton of the capacity. Now, where is that capacity? We don't have it. So till that time, will there be the funds managing and holding the material within the country? I would love to do that, because then you're not exporting and bringing in the scrap. There's a lot of angles to this.
I think Anuj got disconnected.
Yeah. So I guess probably till the time he connects,
Yeah.
I think you blanked out a
Yeah,
bit.
he's back.
No worries, but when they hear the stories, normally people try to blank me out, but that's okay. I love with that. So I believe that we should focus on what's going to happen in the next 5 years. And I'm very gung-ho like what China did. They have their own reserves of copper, aluminum. As and when they require, they dip into that and they can help the country to build the projects. You look at the projects in this country. Let's say you want to build a bridge on Mumbai Road. The project costs 2,000 crore and after 6 months time is 3,000 crore because there is no hedging facilities. There is nothing which we can do. So I think these funds and new schemes and MCX and people like that will give, I would say, support to the projects and to the investments field which is coming in India. So I see a lot of happening over here. And I'm very positive that new changes will take the market in a different drive. And yes, it will take a little time for everybody to adjust, but in the end, everybody will adjust. That's for sure.
Great. Thanks for those comments. Now we have time, just about, I think, 10 minutes left. So, I think a lot of participants want to get some price view, especially in the post-COVID scenario, where base metal prices first obviously had taken a big knock with regards to the demand destruction that was there, starting with China and then extending to the rest of the world. But prices have come back from the lows, and possibly we can just take some price views from our participants, starting possibly with Anurag on your price projections for aluminum from a 3 to 6 month perspective.
Okay, see, it's actually the environment is very, very uncertain. But if you look at from a producer perspective and how do I see the prices going forward in 3 to 6 months, I'm quite hopeful that the prices will improve. I don't foresee a major increase, major jump in the prices, but the prices will improve. There are two reasons behind that. One is the demand destruction which has happened actually has reduced the prices by only a margin. It has not gone down drastically. So it means there is a very heavy resistance at a lower level. So I don't foresee that it will further go down from this level. It has already come to its lowest level. That is one. Second is that the demand after the COVID-19 is now picking up. It has not picked up to the full level, but it is now improving gradually. So if you look at from 3 months to 6 months from now, I foresee that the prices will improve. As the demand will improve, it will also lead to some price improvement. There is another side that there is a lot of inventory available. But if you look at inventory available in the warehouses, where again you don't foresee that it will get liquidated immediately and will really come to the customers who want to actually consume it. So I don't foresee that. So given that constant on the inventory and the positive demand, I foresee that the prices will improve in next 3 to 6 months time frame.
Thanks. Bernd, you obviously are well connected with the entire metals ecosystem globally as well. What is your projections for the price outlook?
Sure. Well, I think we're currently seeing, as I mentioned, so sort of an overextension of the upward price movement from the March lows. As I said, I'm not really looking too deep into, I would say, the fundamentals, but with slowing trade and some of our business cycle indicators still in recessionary territory, if I was a consumer, I would be very cautious of really aggressively try to buy some material up here. I mean, it's as we know, there's always bear market rallies. We're seeing it in equities and likewise in commodities. But it's uncertain, where we're heading. Surely the machines have been buying across the complex, not just, you'll see them buy commodities, equities. Oil obviously has had a couple 100% rally of those negative prices. So I would remain cautious. I mean, as was mentioned many times, I would really look to hedge any open price risks that I have rather than trying to squeeze out another $50 on LME on my physical holdings. But there's a lot of uncertainty. That's why I think I just look at really a good guide is always the CFTC positioning as well. Sort of, I would always look at what are the non-speculators. What is their position versus the speculators? You can get some interesting indications how short or how long the markets are. We know that generally the speculators, if they're overly short at some point, they will have to, cover and get out. And equally, as you approach a very large long position, the scope for a reversal in that trend is very likely, because these are all leveraged products. Volatility is definitely high across the board, or higher up to pre-COVID. So people with the risk management systems, which are based on valued risk models, which are driven by volatility, you will get liquidated very soon. So your scope for holding on to losing position is not very long on the speculative side. So I would just say use those as a guidance, and just don't necessarily buy into the narrative that a lot of the media is posting. Yes, China is restarting, COVID is over. Who knows? It could be a second wave. Let's hope not that it happens. But these are things that the people that are telling you now to get long were not the ones who told you to short before the market crashed. So just be aware of that. And as I said, I use purely a price model because we don't trade anything physical to have insights into the arbitrage. So happy if there's people who want to receive what I'm writing about. I'm happy to have some more in-depth calls to just explain a bit more if that's useful. But uncertain times, I think, have your levels and your stops in when you need them. And liquidity, as we've seen as well, I think an interesting case was the gold market liquidation, slightly off topic, but I think the gold crash in March, when all the risk parity funds who were basically long bonds, long equity, long commodities, suddenly had to extremely sell out of their gold positions because volatility spiked. So yeah, I think it's very careful. The QE of the Fed is just suppressing volatility until it doesn't work again, as we know. Yes, they're stimulating, assets are moving up, but it's definitely something that's artificial liquidity that's being injected and forces people out on the risk curve again, because rates at zero. Yeah, maybe I'll buy copper ETF or an oil ETF for that matter, because it could give me 200% in a week, guys. Why would I hold a 0.5% or 1% bank account? But there's no fundamental reason maybe behind that move. So I just think those are some of the things I always keep in the back of my mind.
Thanks. Before I move on to Anuj for his price forecast, I think one of the interesting reports which I read recently was where Goldman kind of isolated the entire base metals pack and more or less described the fact that those commodities which would be more focused on the infrastructure, so let's say copper and zinc, versus commodities which are more consumption driven like aluminum. In the base metals pack, we always say that if base metals and energy are a barometer of the economic activity, and if that has started picking up, do you see a decoupling happening where you see consumption based commodities not doing so well purely because your automotive demand and to a certain extent your packaging demand would have come off, whereas if there is an infrastructure fund which is being touted about both in the US and as well as in the Britain, that you would see some metals like copper and zinc outperform?
Look, for me, if you really ask this question to me, I look at again. I hear the comments from Bernard and Anurag. They have given me from the producer and from the market view. Now look at what happened in oil. Oil went from 20 to minus 39, whatever the number was there. And because why it happened? Because everybody was making a beeline. There was geopolitical tension between three countries, and the reason. Now flip the question towards the metal side, that what's going to happen. Has copper really come down? It was a blip till 4,300. And after that, strong back and revived till 48.50, and it maintained the level over there for pretty long. And today, if I see, with the China coming back, copper is back to normal. It's 5,400, 5,450. And I'm very strong that it will reach 5,800 level in near future of time. So I'm very clear with the forecast because I see these numbers happening. Now, why we see that? Because, these numbers are not driven by geopolitical fights. These numbers are driven by the industrialists. And you have to understand that, yes, they will not let the prices go down further. As Anurag said that 1450 was the threshold level for aluminium, it cannot go further down. I see aluminium coming back in 1600 in next, I would say 2 to 3 months time. For zinc, we are very positive that 2350 should be the level, and it is slowly inching towards that side. You talk about nickel, you talk about tin, all the prices are firming up. Now, why these prices are firming up? Because the demand is there. And the demand is coming from the very first factor that post this pandemic, in the last 4 months, we have consumed everything which was there on the shelf. So the inventory needs to be rebuilt. which starts from aluminum, tin, and nickel, which is the base fundamental for any food industry. You have to feed those industries, and the people need the metal. People have not started, but look at what China is doing. Today, China is just consuming every ton available in the market. They are very clear that by the time everybody else will wake up, they have got all the tons. They have tweaked their scrap policy till August now. So that means they can consume as much scrap, which they were saying no till January. Why they are doing that? Because they can see that the world needs packaging, the world needs cars, and world will need more and more metal to work. So metal prices will go up. At the same time, I see the army of quants, or we see the army of people who are sitting without any human face over there and punting around. That's a separate story. Anybody can do that. And I definitely believe with Bernard that yes, players are there. It can go sideways, but I see the flip side is less. The upside is more, according to me. And I'm very clear that the metal will come back to the level where they were pre-COVID. I would say the summer general prices we can see very easily in very short span of time. For me, it's demand and supply, and demand is going to be there.
Excellent. So very different views, and I think, as Anuj mentioned, it's a producer view, a trader view, and someone who tracks the quants and the big picture algos as well to kind of get a balanced sense of how the markets are reacting. But these are challenging times. In the market, it's very difficult for anyone to do a price forecast more than a quarter, about 6 months, and especially with geopolitical tensions also surfacing between US and China, it's again going to be a very volatile ride. So we have time for only 1 or 2 questions now. I think the first question is more again towards Rex. Yeah.
Sorry, Viral. I mean, while everybody has right to have an opinion on the market, and so does, I mean, we're a neutral party, but I still have an opinion on what should be and what should not be. So my point is that if whenever you have in doubt, you should look at MCX prices, and whenever you are confident of what is happening, to reconfirm also that you should look at MCX prices. So this is going to work both ways, looking at the MCX price.
We love that sentiment over there.
So I think most of the questions on the price forecast and all have been addressed, so I won't kind of reiterate it over here. I think the last question to sum up possibly is again a little bit on the way forward. Probably 6 months from now, where do you see? So MCX is probably, I think, has seen a peak inventory of about 25,000 metric tons. With all these changes that we are seeing, in terms of new participation, MCX also being able to kind of give some roadmap in terms of whether new delivery centers will come in different parts of the country. What would be your assessment in terms of what do you see the growth of this entire warehousing space or the delivery part, and new innovation, new products that are likely to come? Probably, Rajan, you can address that first up.
Sure. So if you allow me to probably prioritize the one change which is happening is being implemented from June, that the lot sizes gets revised. That's part one. Part two, in terms of reach, definitely on agenda, but that it's going to be slightly behind on priority. Next clear-cut indication what we have is about the index approvals, and once that comes in, that will certainly find priority. We are working already on looking at domestic brands, and as I already mentioned about lead, so that's already work in progress, and I believe that should also find a priority. So talking of this financial year, I would say additional delivery centers, yes, but I do not have exact timelines on that, but for sure additional grades and the domestic brands are definitely on agenda, and I'm very keen to see the index going live.
Thank you so much. Unfortunately, this is the only time that we have. So, thanks to all the gentlemen, all the fellow panelists for taking time out of your schedule to attend this and participate in the Class Apart Masterclass series hosted by IFA Wealth in conjunction with MCX today. Thank you so much for your time again, and for providing great insights into the topic of changing trends and changing face of metals trading and investments in India. For our clients, if you have any further queries, please reach out to our relationship managers. Thank you so much, gentlemen. Stay safe and have a nice evening. Thank you.
Thank you,
Thanks.
Bharat.
Thank
Thanks a
you.
lot.
Thank you.
Thank you. Thank you.
Yes.
Yeah.
Bye.
Thanks, everybody.